Hello and welcome everyone. Happy Friday and happy first day of September. Hopefully everyone's month is off to a great start already. My name is Alexis Rogers and I'm the customer relationship lead here at RightCapital, and I'm very excited to be here with you guys today right before a nice long weekend for Labor Day. And welcome to our presentation today on how to analyze client insurance needs within RightCapital. And so our goal for today is to just further strengthen your understanding of running insurance analysis within RightCapital, and to also just illustrate all the different ways you can apply different insurance analysis within RightCapital in your everyday practice. And so a lot of the tools we're going to be going over today can serve as great visual backdrops for those conversations that you're having with your clients in which you are addressing their insurance needs, which is a very common topic in today's day and age for sure. And so some of the things that we're going to be highlighting today is we're going to be going over some of those assumptions and the nuances that tie from assumptions within RightCapital, and just making sure that everything you're using when you are creating a projection for a client plan is aligning with what you want to have utilized when you're running life insurance analysis of different sorts. And we're also going to be highlighting, of course, and overviewing life insurance analysis and the foundations of life insurance analysis within the system, and how the system is looking at different life insurance calculations. We're also going to be going over the process to make sure you're really tailoring your analysis to your individual client plan, and also just aligning your beliefs with what you want to have run within the system in terms of those life insurance analysis as well. We're also going to be highlighting disability insurance and having a deep conversation there in terms of some of the visual tools within RightCapital that can assist with any conversations that you are having with the disability insurance analysis. And of course, the very important need for disability coverage, especially in today's day and age with a lot of volatility going on. And then, of course, at the end of this, we will be having a live Q&A. So if you have any questions, please feel free to navigate to the GoToWebinar panel and just drop your questions right there into the questions menu dropdown. And I'll be more than happy to just answer any questions you might have throughout the system and throughout the presentation. So please feel free to interact with me from there. And just shifting gears and then navigating into the RightCapital platform, the first thing that we want to highlight today is just those assumptions like I was talking about earlier, and just making sure that we're understanding what's going into each of the very important calculations for future projections and what's going on when we are looking at insurance analysis. And so, of course, the first thing that we want to highlight within this assumptions tab is your asset return assumptions. And so just understanding that, of course, this is where you can find your global assumptions for different return assumptions. And also just ensuring that this is going to be, something that you want to have set as your global standard for this historical index returns, or something like forward-looking return assumptions from JP Morgan studies, which is going to be a little bit more conservative compared to historical index returns. And then you also have the ability to enter customized returns for your global assumptions as well. So it's just, this is one of the key things that we want to highlight, and that, of course, when we are looking at something where we are calculating how much coverage someone might need in terms of their assets being protected and surviving throughout their lifetime, these return assumptions can play a vital role, of course, in calculating what their portfolio return is. And you just want to make sure that this is all aligning with what you want to have utilized in terms of those projections within the system. Another key factor is also under the inflation tab within the assumption section. This is also going to be one of those global assumptions, but just making sure that this aligns with what you want to have utilized in your future projections, as a lot of this ties directly into a lot of the insurance calculations. So things like general inflation, anything that would be impacted by general inflation, just making sure that this 3% is what I want to have set as my standard. And then the same thing for healthcare cost inflation here. So right now we're using 5% for healthcare cost inflation, but this plays a key role. And of course, if you're having conversations about Medicare premiums or long-term care insurance analysis, the healthcare cost is going to have a direct impact in terms of the inflation for certain healthcare costs and for long-term care costs in specific. So just making sure that this 5% is what you want to have set as your standard. And the same thing too for education cost inflation, as oftentimes if we are having conversations for life insurance analysis, sometimes people would want to have their kids' college goals, funded even if they pass away. So we want to make sure this education cost inflation, if we are considering that sort of goal for that type of client, that we're having this align with our beliefs as well. And then the same thing for, of course, Social Security inflation figures or the cost of living adjustment with the 2.5%, and making sure that this is what you want to see for your assumption for cost of living adjustment. And the same thing for tax inflation as well. And so these are just some of those founding factors that have an impact in terms of when we are looking at those future projections in general, but even more importantly, when we are looking at things like insurance analysis. Another key thing to note within assumptions is actually within this miscellaneous tab. Here we can find some of those miscellaneous assumptions, such as cost of purchasing a real estate property and cost of selling real estate property, but even more importantly, the expense adjustment upon the death of a co-client or client. So this is vital. Of course, if we're doing some sort of insurance analysis, you want to make sure that you've entered here, what you want to see as an adjustment in terms of how we're going to be reducing living expenses when a client or co-client passes. So of course, if we're illustrating one client's passing away, this would be the figure that you want to make sure is reflecting what you want to see in terms of that living expense adjustment. And so once again, everything that we're doing right here is straight within the advisor portal is going to be in a global assumption setting. You do have another ability to enter customized assumptions for individual client plans as well, which I'll highlight shortly. And so just pulling up the Waynes today, which is who we're going to be working on. And just to highlight too, while we got the plan pulled up, if you wanted to have customized inflation figures or customized returns for this particular client plan, you have that functionality available to you by navigating into the gear icon settings section for this client. And starting first with the other assumptions, this is where you can change from global assumptions here to custom assumptions in terms of general inflation or those miscellaneous assumptions. So this is a key place to go if you want to have something more unique for this particular client plan and how you want to have their projections run. The same thing for return assumptions. So for example, for these for the Waynes, I have forward-looking assumptions selected here just to have as opposed to the global assumptions that I have, which are currently the historical index returns. So you have that functionality available to you. Just make sure that you're, ensuring that you're tailoring the foundations of this client projection to what you want to see for this particular client plan, and especially when you are trying to run something like an analysis in the future, and especially targeting insurance. So those are just some of the key factors and assumptions that can play a role in terms of those future projections, of course, but even more importantly for when you are trying to run a proper analysis of, their insurance needs. And so once you have that done, just to give you some background as to the Wayne situation. So they're currently, Bruce Wayne and Rachel Wayne are both in their mid-40s. They have a child, and so they are also going to have some college goals founded based off of that. They have, they're going to be retiring in their mid-60s. They've got some good, retirement expenses of $10,000 a month. We're also going to be considering long-term care costs for them, and also, annual retirement healthcare costs. They're currently earning $260,000 and $150,000 each. So they're a fairly, affluent family, but they're pretty typical, and we are considering Social Security for both of them as well. Another thing to note is that they are pretty avid savers, so they are contributing. Bruce is contributing maxed amount to his 401k. Rachel's contributing, $28,000. There's a little bit room there for potentially more contributions, and they're saving pretty wealthily into their brokerage account on the side as well. And then they of course have their pre-retirement living expenses being a little less aggressive in comparison to their retirement plans. And their current net worth is looking about roughly $2.5 million. And so they're pretty, typical family, that especially for life insurance analysis and wanting to, of course, ensure that they're protecting their net worth and especially for their child as well. And so one of the key things to consider too when we are trying to run a life insurance analysis is that just understanding that the foundations of this calculation when we go into the insurance life insurance field, this is going to be looking at ensuring that the surviving spouse has a positive ending portfolio value, meaning that they have at least $1 in the bank account when they pass away. And so maybe that's, not exactly what the Waynes are looking for. They want to ensure that they have something like, maybe like $1.5 million left in their assets to ensure that, their daughter is going to inherit some nice wealth when they pass away. That'd be a situation in which we want to navigate into the profile section here. And if we go to goals, add goal, we can add a legacy goal here. And we can indicate, how much we want to ensure that the plan is ensuring is left at the end of the surviving spouse's plan. So that way the heirs will have some sort of assets to inherit. If we want to have something higher than, just ensuring that they have a positive ending portfolio value, if you have a specific goal in mind, this legacy goal can be one of those ways you can illustrate that and make sure that that's included in terms of any insurance projection. So let's just save that. And then let's hop on over into the insurance analysis and life insurance in particular. And so this is where you can really start to get down to the heart of, evaluating someone's life insurance or protection need. And so this protection need is going to be calculated based off of what would need to be a benefit in order to ensure that either surviving spouse has a positive ending portfolio value. But what we did with adding that legacy goal is we ensured that we're also considering that we want to have 1.5 million in there as an asset left over as well. So we're going a little bit further and we're further tailoring this particular life insurance analysis to these particular clients' protection need analysis. So it's just one of the ways you can further customize and ensure that you're addressing their particular needs within RightCapital. Another thing to note too that's pretty handy in terms of further customizing this sort of insurance analysis within RightCapital is if we navigate here down into the action items, we can see more details as to what is going on. Of course, we can see what their dollar amount of the life insurance need is for both of them. And we can also see, a couple different things populated here. You can propose additional life insurance. You would see any sort of current life insurance coverage. But you'll also see here that you can also apply a debt strategy. So if we navigated back into the profile net worth section real quick, they do have, a couple credit cards. They've got a little bit of a mortgage left over that's occurring right now. That would be something that, if one of them passes, maybe we'd be taking an approach that we want to start paying that off and we don't want to have that outstanding. And so you can apply a different debt strategy for each of these individual protection need calculations or this life insurance module. So let's say we wanted to pay off all debt immediately if Bruce passes away next year. And then we can click this refresh button and we can apply that to this analysis and have that incorporated in terms of what would be needed to have a protection need to ensure that we can also achieve this goal in mind. We can even take it a step further too by clicking on this edit button. And of course, as we know, if somebody passes away, there are going to be a lot of changes that would occur in somebody's life, not only financially, but maybe in terms of goals or things that we'd be addressing with our clients. So you have the option to include additional things to edit here and to modify. So maybe we'd be looking at potentially their retirement monthly living expenses. We want to also address, Jennifer's college goal, because maybe if one of them passes away, we wanted to ensure that her college goal is funded, but maybe she'd be going to a different school. Let's also incorporate that legacy goal and also their salaries and savings as well, because maybe we're going to have some different priorities. So once we check those off from that list and hit save, we'll now see everything that I just selected populated in the action items for us to propose changes to and to manipulate to further customize this life insurance calculation for each individual client. And so this is very useful in, of course, modeling those scenarios of, what's going to happen if somebody passes away. Our goals are definitely going to change. There's going to be some sort of shift in what we're planning for if somebody does pass away and what we're going to be prioritizing. So things like, maybe Jennifer, if she's evaluating going to a different school, maybe we'd be decreasing her college cost and what we're funding And then the same thing too, maybe Rachel will be reevaluating if Bruce passes away. Maybe she's going to have a split of time between trying to have a work-life balance set in place so she can spend more time with her kids. So maybe she'd be earning less in this scenario, but maybe cutting down on expenses in general, just because she's going to start to make sure that she can maybe start saving more potentially. So let's hit that save button. And then you can apply everything that I just curated, and that'll be reflected, and we can see that impact on the life insurance protection need that's calculated for Bruce. And then the same thing for Rachel as well. So maybe things would change. You know, maybe we'd want to increase this legacy goal and see the impacts on their plan for both of them. And maybe the same thing for Bruce. Maybe he'd be taking, you know, time off from work if Rachel passes away. And so you can make all these changes to have a very dynamic calculation and approach to the protection need for each of the individual clients, and to just show that impact too of, you know, this is what's needed to ensure that we can address all of your goals. And especially because things will change if one of them does unfortunately pass away, you can also address that dynamic situation of this is what we need to do to ensure that we're, you know, funding that scenario in which we might need to be reprioritizing certain things, and also what might need to be happening to ensure that we're covering, you know, all the assets that are necessary and leave the legacy goal as desired, of course. Another great visualization within this tool is we can also see within for Bruce and for Rachel what the income shortage is if Bruce passes away, you know, which years we're running out of you know, money we're needing to pull from portfolio. We can also view what's occurring with the invested assets if Bruce passes away. And we can see, you know, of course, she does run out of money, roughly around, you know, 77, 78. So it's a great visual tool to show, you know, even if you'd have to live, if you live past 77, you know, with our current projections and everything, we would be running out of money if we didn't have some sort of protection in place. And you can also show the same visualization with if Rachel passes away as well. So here we can see that, you know, Bruce's lasts a little bit longer. He's got a little bit more cushion with his job, so he has a little bit more flexibility. But this is just one of those things that you can see that visualization of what is happening with the assets, how much in total we're running out of. We need more money for this amount. And this is also something that you can also show that, you know, right now we have a $6 million income shortage at the end of plan. But maybe that's something that you can have that conversation of maybe we need to reprioritize and then rebalance our portfolio. And you can propose something like changing their allocation from their current allocation, which for them is a little bit more conservative, and show the impacts of something like maybe something more moderate. And maybe vice versa too, if we had to change from an aggressive portfolio to a more moderate portfolio if the spouse does pass away. So it's a lot of functionality here if you can show that instantaneous impact of what it looks like and maybe what we need to be doing to ensure that, you know, we're surviving off of the assets that we have and the protection that you might be recommending. So it's a lot of key visualizations there. You can also see further breakdown within this details tab of, you know, what's occurring with the cash flows for either spouse passing away. You can also view here things like the ending account balance and what's occurring for that growth if you want to see that year by year breakdown and everything in between. So it's just another way to get a little bit more granular in terms of the information within this particular module. And so this is something that you can fully customize and tailor to this particular client's plan and to their unique needs. One thing that if you are running an insurance analysis, is particularly for life insurance, if you navigate into the three dots in the right-hand corner and into calculator, we do have this calculator, it's human life value calculator, and this is more of an income replacement calculator. So this is a great place to also navigate to see, you know, and understand what the value of their future earnings in today's dollars and what we might need to be protecting if we want to ensure that, you know, somebody might have that same sort of income stream or have that same kind of cushion if we wanted to maintain current goals and things along those lines just purely on an income coverage calculation basis. So here within this human life value calculator, you will find this pre-populated with all that information that we have built out in our current plan back within our profile section. Here we'll see what the annual income is for each client and co-client, how close they are to retirement, and also our discount rate, which is going to be what we're applying to get this future projection back to present day dollars, and then also the tax rate applied to this assumption as well. And so you can fully play around with this to see, and maybe assume that there's lower tax rates and have it be more in future projections by removing the discount rate. And you can see, what would need to be in terms of income coverage if we're trying to replace just that income stream itself, and just ensure that they can maintain the current lifestyle for either Rachel or Bruce. And so you can even play around with the idea of, if Bruce was actually planning on originally retiring later in life, you can see that fluctuation and that impact to this calculation itself. And maybe if they needed to, you wanted to assume that there was going to be more cushion at the job as well. So this is a great place to also look to just see another form of insurance analysis, and also that figure of replacing income from the future, but in today's present day dollars. So another key visual within RightCapital to have and further bolster your conversations that you're having with your clients in terms of that protection need. And so once you highlight all this information, this is a lot of the different great ways you can view and illustrate the impacts of and what we need to cover in terms of life insurance. So, and a good thing to note too is that everything that we input as those foundations that I highlighted earlier for that current plan within the profile section, all of this is vital to ensure that we're of course entering the accurate information and just making sure that it's as up to standard as can be, because it is important when we are looking at these insurance analysis, because it plays such a pivotal role in calculating, of course, what the insurance need is. So as long as that's accurate, it can really help bolster your conversation, ensure that you're having the most accurate and most effective conversation with a client in terms of life insurance analysis itself. Another key thing in terms of insurance analysis is our disability analysis module, also located under insurance. Here is where you can, have that conversation about a very important conversation about ensuring that we're having another form of income coverage if somebody is disabled tomorrow. And so what sort of coverage would be needed to fully replace that income as well. So this is very vital, especially things can happen. You never know what's going to happen. So this is another tool that can be used for that conversation as a nice visual backdrop. And so you can see right now that the Waynes, they don't have any coverage, which is a shame because they do have pretty high paying jobs in consideration. So if something does happen, and we can't fund, that income, if they're disabled, then, that would be a shame, especially considering that they had some pretty nice goals in the future. So this is a nice place to have that conversation of what it looks like for if we do have some sort of disability insurance. And so you can also use these action items to start to customize and illustrate, and tailor this disability analysis to this particular client plan. So we can change things like when we want to assume that disability will be ending. So it's going to be defaulted to ending at their retirement, but you can choose for it to be for a shorter period of time. So maybe a partial disablement for a couple of years, but let's assume that it's going to be until retirement for both of them. But you do have that option available to you. And then further below, you'll see the ability to indicate what you want to illustrate as the proposed insurance coverage for disability coverage. So you can indicate, how much of the proposed monthly coverage there will be. So let's say there would be something like $10,000 a month. You can indicate, how long this would be insured through. So age 65, or whether it would be for just 90 days, 180 days, 10 years, age 67, or even age 70. Let's assume for him it's going to be age 65, which also just happens to be when he would retire. And then you can also illustrate what the proposed elimination period is. So how long he would need to pay out of pocket before his benefit kicks in. So let's assume, 30 days. And then you can also have an inflation adjustment applied as well. So let's say it's going to be 1%. And you can choose whether inflation is going to be compounding or simple. Let's say simple, and also enter that annual premium. So let's apply that for Bruce and see what happens from there. And so as we can see, he does have a gap in terms of that proposed additional coverage, but he's covered roughly, almost 40%. And then you can do the same thing for Rachel. So hers is going to be a little bit easier to cover because she's got a little bit less that she's earning. So we'll do $12,000 a month. Also age 65. But let's have her proposed elimination period be 360 days, no inflation. And so you can see that impact of that proposed coverage instantaneously once you hit that refresh button. You can see that, now Rachel has 66% coverage just in the summary portion. But we can also see a further breakdown within the Bruce and Rachel pages for each client and co-client, where you can see year by year breakdown of what is being covered and where the gaps are. And so for Bruce, this clearly it's not enough to cover half of what he would have received. So maybe we need to look at having a higher policy, maybe $20,000 per month of coverage. And you can show the impact too of when we have something that's a little bit higher coverage, that impact now he's at 74%. And you can also show like the difference of the elimination periods as well. So if he had to pay, for example, a full year out of pocket prior to getting coverage, you can see that impact and why, maybe that might not work, and maybe it works for a little bit for that 1 year when we have that cushion. Maybe we've got a lot of liquidity set aside for emergencies for this sort of emergency. So you can have that flexibility, and maybe you would have a higher coverage in that instance if you did, have a higher elimination period. And so if we do that, they have a lot more freedom in terms of what is covered and having some sort of coverage in the future. And so you can show that impact. You can see the difference between all these different sorts of parameters for disability coverage. And you can see a nice little visuals in terms of what's happening for their assets as well if Bruce does become disabled tomorrow. And you can see that if he does have this proposed coverage, he'd have $74,000 more in ending assets. And that'll last him 21 years longer than if he didn't have this proposed disability coverage. So it's a great visualization as to, why it is important to have disability insurance and what sort of disability parameters should we be leaning more towards, and maybe what are we more comfortable with trusting that maybe some assets will cushion that fall in terms of elimination periods. And the same thing for Rachel. Of course, we can see that impact to her invested the invested assets if she does become disabled, and the same thing for her income coverage as well. And you can also see, of course, more details in that more granular view of the year-by-year breakdown of something like the cash flow summary if either of them becomes disabled tomorrow by selecting either of them from this dropdown. And you can view their cash flow summary and also what's happening with their assets as well if either of them becomes disabled. So there's a lot of key information that you can highlight here, and a lot of valuable things that you can utilize for that conversation where you can highlight the impacts of course, ensuring our assets are gonna, of course, we have those available to us, but we want to also ensure that we're not necessarily tapping into them if an emergency does happen where we, have to have some sort of disability insurance kick in. So it's a great way to highlight the impacts of course, covering our income need, and also just showing the impacts to their assets as well if they don't have that sort of income coverage. So there's a lot of great information there. Another great thing, of course, for a common conversation is the long-term care insurance analysis as well. So within this long-term care insurance analysis module, also featured under insurance, of course, this is where you can have another conversation about, what we're going to be doing in terms of ensuring that we are protected in the event of long-term care. And so here we can see what assets look like without long-term care, without the long-term care expense or the long-term care event occurring. And you can also show the impacts of assets with long-term care expense and any existing insurance, which they don't have any. And then once we start to propose a long-term care insurance here, we'll see that impacts. But just to show you like that visualization of, if we have long-term care expenses, as you can imagine, at the end of their plan, they are showing, a significant decrease in assets in comparisons to not having long-term care. And so if we navigate down to these action items here as well, we can start to play around with proposing coverage for long-term care policies. So let's see what it looks like, if he has something like a $50 coverage per day. You can indicate what the benefit period would be for this long-term care insurance policy that you're looking at. So let's say it's going to be for a year for Bruce. And also you can indicate any elimination period or any delays of when you need to be paying out of pocket prior to the benefit kicking in once you do enter long-term care. And also if there's going to be any inflation adjustment to the benefit itself. So let's say there is going to be an adjustment of 1%. And we can do the same thing for Rachel as well. So maybe she's got a little bit less, but her benefit period is longer and she's got no elimination period. And so you can show that impact, maybe if we have a little bit higher, let's say $140 for a day, you can see that impact in terms of where we're protecting assets. And we can see that, this current coverage might not be enough to ensure that we're, cushioning their assets in the event of long-term care. And so maybe we need to look at something with, higher protection. But you can see that impact of if we do have that long-term care benefit in place, we have, of course, higher ending asset values because we're not needing to tap into our assets to fund this goal any longer. So if we have this coverage, we'll have $452,000 in higher ending asset values as compared to not having this long-term care insurance policy that I just proposed. And so this is a great way to have that conversation of, what is happening with assets, of course, without long-term care expense. And then you can show, if we do have long-term care occur, this is what's happening with our portfolio. And then if we have some, some sort of protection in place, we can really cushion that, our assets in the long run. And you can also view a coverage analysis as well. So if we click into coverage, we can see this nice visualization of what is covered for their actual long-term care cost. And so this is a great place to highlight and illustrate what the actual cost is for long-term care. So this is one of those things where that healthcare inflation figure is important to make sure we got down to what we want to see, because right now with the 5%, if we run with that assumption of the average of the 5%, that's going to be inflating our long-term care goal cost each year. And so just to highlight, what I had back in the profile goals where I did set up this long-term care cost, I'm just using the national average for in-home care. And this is actually one of the lower costing national averages too. So going back into the insurance, long-term care insurance analysis and back into coverage, you can show that total cost, with considering that they're in their mid 40s, we have decades before this long-term care event occurs at the end of their plan, that 60,000 is growing with that 5%. So the total cost for Bruce is $1 million, and the total cost for Rachel is a little bit higher, $1.1 million for long-term care. So it's just something to highlight. This is a pretty big event that's going to be occurring at the end of the plan that we want to make sure that we're, of course, having some sort of cushion for and coverage. And so you can show that impact too if, right now we're not insured, but with this proposal, what would be needed to ensure that we're covering most of the long-term care cost, if not all of it. And maybe that conversation of what are we comfortable pulling from assets from, or do we want to, of course, be pulling $1.1 million from their assets end of plan, which probably not. You probably want to have some sort of coverage. So it's a great place to be having this kind of tougher conversation and taking a deep dive in terms of what we need to protect at the end of our plan and what we want to be pursuing in terms of having that sort of protection.